a well requested episode after Chris got piqued my excitement. We'll say I haven't had the opportunity to look back really into Dutch Bros since the IPO. I have a few friends that are really into it, and then Chris last week kind of piqued my interest. Just so happens that there was one where I was vacationing last week, and so now looking at it, looking more and more in depth. I listened to the conference call on the way home. It seemed like a pretty cool opportunity. So, Chris, you might have to reel me in on this one, man. It looks pretty dope. So, I don't know about some thoughts, initial thoughts that you want to kick off with, but I have some initial DD that I was sending you out throughout the weekend and
Yeah.
today. So, just curious where your thoughts are just starting off.
Yeah, whenever I look at stocks or anything, the first thing I try to ask myself, like, how does this fit any sort of business model that makes sense, right? And is there a blueprint for success that's been applied in the past that this company can pretty much put some its own uniqueness into it and then use that same business model to grow itself? I mean, sure, there's going to be differentiating points here and there, but when you think about it, this is a traditional franchise model where you have a product, that's the differentiator, the core product, and that's something that I'm sure that you'll talk about because you actually got to experience it. It's something that actually is growing on people, but the model is very asset light and it's very cash flow heavy into the future, right? So when you think about it, all it really is just sugar water, right? You're just taking a bunch of liquid, putting it into a concoction, then selling it at a 500% markup, right? That's what Starbucks does. They just take coffee beans, they roast them, they make coffee, and then they have like a high schooler sell it to you for a huge markup, and it's a very profitable business, as
Yep.
clearly as everyone can see. So people right now, even though the sensibility is you could probably make a coffee at home for $1, there's or even less. There's some uniqueness to the way that some businesses can really develop a brand around their core product, and it's something that people, especially if they're on the go, they're not exactly looking to always make things from home, and so they're willing to pay that additional markup. So whenever I look at a business, I'm like, okay, what is the markup that people are willing to pay, and then how much of that markup can go into the operating expenses, and then after that, what is the profit that's left? And so when you look at something like Dutch Bros, you can kind of see a very asset-like business model. It's a lot of concentrated stuff that they take. They create a product, which is of course their coffees and their energy drinks and everything else. And it's something that a lot of people have really liked and they're into. And so um, yeah, it's a tried and true business model. They're very young in their life cycle, so there's a ton of growth potential out there. They've got a very captive audience in the youth that particularly like to frequent it, and I think the growth potential here is very high. So while it does not traditionally make the sense like in terms of like a value normal valuation that you would look at a established business, you have to take things into consideration when it comes to growth. And so what you're doing is you're paying for that growth up front, but your estimation should be that the growth will compound itself way faster than the total worth what it is right now. So and this is the mistake that I think a lot of value investors tend to make is they try to get the absolute bottom. And I'm a value investor for the most part, so I totally understand that. And but that's why one of the reasons why I've missed so many great companies, because the valuations have always been, oh my God, this is a stretched valuation. I don't want to buy it unless I get the absolute best valuation. And
Right.
you can make a mistake. Like Chipotle was a mistake like that. There are multiple times over this decade that I wanted to buy Chipotle, but what's always held me back is, oh, the valuation is really high. So
Hmm.
there are certain things that when you factor in the growth, and especially compounding growth on a franchise business, it's a cash flow machine.
Yeah,
So
it will be. And I think the one thing that you touched on that I listened to more and more, and I noticed it while I was there in person twice last week, and I wanted to see just from a corporate standpoint if it spilled over into the conference call, and it did
mhm,
100%. And what I'm talking about is company culture, right? So
yeah,
you hit it from a branding perspective, a marketing perspective about how it seems like they're kind of trying to market this thing. It's like the culture is the same. And the thing that the bro like culture, right? And people are kind of feeding into that. They're not like saying, oh, this new sort of wave of like, oh, why can it be bro and broettes? It's like everyone's a fucking bro. Doesn't matter. It doesn't matter if you're a woman, guy, whatever. The thing that's most important that I heard in the conference call, which you probably heard about as well, you can't franchise, you can't open up a store unless you've worked at a Dutch Bros. And the thing that is most beautiful that I kind of heard in the conference call itself is they are looking internally to hire and get people from the beginning to create their own franchises or create future stores. So they're looking internally at managers or people that have been with the company, and it's the average person that they have. I think they have a pipeline of 300 candidates within the company that are going to open up their own stores, which they're aiming for about 4,000 stores in the next 10 years. So that's about an increase about 3,200, 3,300, I guess, depending on what number you're looking at over the next 10 years. There's 300 candidates within the company today that have a 7-year average tenure that will be opening up Dutch Bros. And the hope is with Christine, she did a phenomenal job on the conference call not today, the other day. And she's going to be the incoming CEO starting January 1 of 2024. She has been kind of hitting the ground running. And I want to get back to the Christine January 2024 thing as well. But it just made me feel like they're really taking not only the brand serious, the internal culture and the people of the organization who are driving that experience very seriously. And they're also taking the customer experience very seriously. And so to me, I think it's pretty cool to kind of look at initially. And there were some other things in the conference call. One thing positive, another thing that's kind of scary to me. They are spending a little bit of capital. This is a positive thing to open up a roastery outside of Dallas, Fort Worth. And so for everybody that's kind of thinking about this from perspective, Texas, they've been hitting very heavy in creating what they were calling and talking about at the conference calls, infill locations. So they had a bunch of different Dutch Bros nearby, but then they were kind of like testing 4 to 5 within a couple mile radius of each other throughout. So it's like, I remember when Dutch Bros first opened up, probably about 2 years ago, I was going to a place next door. I didn't actually go to Dutch Bros back then, but 2 years ago, they opened up the first one or the second one in Houston. I looked on the map today. There's probably 10 or 15 surrounding the entire city of Houston. They're not in downtown Houston as of yet. And then I looked at Dallas, San Antonio, Austin, and it's the same exact thing looking across the entirety of each of these. They have yet to really expand much east of Texas. And they're opening up a roastery outside of Dallas. Every coffee bean that is roasted within Dutch Bros is currently coming from Oregon. So you have to think they have to transfer it all the way from Oregon, all the way to Texas. Now, if you have the opportunity to roast your beans in Texas, the ability to transfer that to Tennessee, to Florida, to Louisiana, to all these places east of Texas makes things a lot more easier and opens up the Eastern Seaboard, which is currently untapped for the company. Now, that's a very positive thing, one, because of future expansion, and then two, the opportunity to increase margin in the areas around Texas, which Texas, it looked like, has probably the second most amount of stores, if not the third most amount of stores after, say, California, which, it's a pretty big city. You have 4 or 5 big cities within Texas, and then all the smaller cities like Waco and a few other small towns that get the stores themselves. The thing that scares me a little bit is management transition is always somewhat scary. And so you've had good success so far getting the company through the IPO in the last several years with this previous CEO. They're doing a good job of succession planning. They brought Christine in back in February. She has a marketing background. She has several large corporate chain backgrounds as well. And so it's something that can kind of help, bring things kind of forward. But as always, it's a very scary transition time. So that's something I'm going to be keeping an eye on. And then lastly, before I hand it to you, because I've been talking for about 5 minutes, is I did actually initiate a position. And so it's a small position. It's not very large, but it is definitely a starter position. So it's not minuscule. So we'll see how that continues to grow throughout.
Yeah, I mean, she has a background in managing this specific field. So, but the one that always interests me is this one right here, which senior vice president at Starbucks, because they have a very similar product, right? So you kind of want to have someone with experience selling the same product. She's also got an investment banking background, which is amazing because when you're thinking about business operations, you kind of want someone with that level of sophistication on how to allocate capital, and then this way you can actually grow much further, right? So I think in terms of getting someone who has the management experience to take on the next level of growth for Dutch Bros, I think they hit it out of the park with this new addition. So it's worth definitely taking a look at it. But this is one of those times where you have to keep things into perspective, right? When you do have leadership changes, you are always excited about the new CEO, but you also want to see, like, okay, what are they going to do to manage that culture? And I think they're going to do fine. I don't think that there is, the founder of this company is still involved. The person that helped grow it to the degree that it is, and they're still involved. So this is just a more active role where someone is doing more managing day to day and taking things on from a business perspective. And yeah, with someone like someone having that executive background in Starbucks helps, in my
Mhm.
opinion, growing it further. So it's worth, like I said, it's worth taking a look at. But the thing with this company, and this is one of the things that people are going to have to just give it some grace on, is that this is a long-term story, right? I know that sometimes I get conflated with, oh, Chris is a short-term investor, he's a trader, blah blah blah. But this is definitely one of those companies that their total growth potential is something that's going to be in the range of like decade plus. Now,
Mhm.
what does that mean? That means that on your money today, it'll compound pretty regularly, but you will not see the sudden rise in stock price overnight. Like, I don't. This is not one of those things where you're going to have an S curve like growth scenario, right? So I think a lot of times people want to see like a shit ton of growth in a very short period of time, and I'm like, no, you're going to see a really good rate of return, but it's going to take a decade to get there, which is fine if you think about it from just an investing standpoint. If I can 5x my money in 10 years, that's still fucking really good, you know.
Mhm.
So I know some people want like that 5x like within 6 months, but that's rare that happens. But this company, like I said, has a lot of positives going forward. They're very young in their growth cycle, and I think they're going to execute well. Now here's the question, and this is like the Peter Lynch question. What did you think of the product? What did you think of the experience, the ordering, all this stuff? Just give us a rundown of that.
So the product itself, so I really like the muffin tops that they had. I will say very limited food selection, right? So there's like 3 or 4 different items that you can get, 3 of which are muffin tops. You can get a lemon, you can get a chocolate chip, which was fucking phenomenal. And then there's like a orange scone, something or other that I didn't get. It didn't sound as enticing, but I've heard it's really good from other people that really like bros. And then the third thing or the fourth thing that you can get is a granola bar. Now, this granola bar was the best thing, or the best granola bar I've ever had in my entire life. It's not like a hard one that you kind of get from Nature Valley. It's like soft, and you have that ability to kind of chew on it, which I thought was really good. I didn't get any hot coffee, which I guess in retrospect is a mistake, but I realize that there's a lot more in Houston. Unfortunately, none are directly on my way to and from work, but close enough where I could take a quick stop by and see how good the hot coffee is. But the one morning I got kind of just like a regular, what was it called? A Golden Eagle. I thought that was very tasty. Went down very quicker than I wish because they're not very healthy. And then the other one was
Hmm.
like an energy drink kind of like thing, which was like a lime blueberry or something like that. That was absolutely phenomenal. Um, Kind of reminds you of like a Monster to an extent, but in like slushy
Hmm.
form. So I thought that was really tasty. The Bob Marley that I got, which was kind of a secret menu item, it's like coconut, banana. That was tasty as well. But it's kind of
Hmm.
not. I'm not going to downplay it. It just doesn't really seem like my thing. I like banana and peanut butter sandwiches, but not really coconut and banana sort of coffee-ish sort of flavors.
Hmm.
I love all of them separate, but not in one drink. It's not that it was bad by any means, but It probably wouldn't have been like my number one choice, but it was still very tasty. The experience about driving through, the customer service was really nice. I definitely could tell the culture of the people was there, the bro culture, but it wasn't like a, oh yeah, bro, like, you know, it wasn't like a
Yeah.
Cali, like weed smoker sort of vibe. It was like a very relaxed, chill sort of tattoos, backwards hats sort of thing is allowed in that sort of culture. The thing that bothered me a little bit, and somebody mentioned to me, it's kind of like Chick-fil-A. If you go to Chick-fil-A, which, you know, you're in Georgia, so you know a little bit about, they have like the people that come to your car windows, not really ordering at a drive-through. I don't know if that's familiar for you guys in Georgia, but that's how they kind of do things in Texas. So instead of ordering it at like a drive-through sort of speaker box, you actually have somebody come to your car, talk to you, which is a nice gesture because it makes it feel like more customer servicey rather than kind of through a speaker box, which half the time those things don't even work. So it's nice to be able to have that kind of iPad sort of experience. The thing that did bother me a little bit was the fact that there was a line, but that means good business, right? That people are willing to do that. But it was a little slower than I was expecting. It not to an extent where I actually got annoyed, but I noticed I was just like, this is a pinch point, right? So the thought process was you could definitely get your asset unit value up, or annualized unit value up, AUV, which is a big thing they talk about in their conference calls, if you were to get more people through the door. And so with that, I'm like, how is that something that they could make slightly more efficient to get people through the door? I don't know, because they only have one window, right? Do they do two windows sort of set up? Do they have kind of like a running lane where you have the ability to kind of have two people coming through at the same time? I don't really know what the answer is, but I could see that the biggest pinch point that I saw, everything was well received. The only thing that was not well received was kind of that big pinch point of one window, one transaction, you know, and not having to be able to do multiple transactions at a time. So that's kind of my thought.
Yeah. That's good, man. So I taking from what you just said, you liked it. You liked the experience overall. It wasn't something that was away. The product itself is good. The lines can, from user experience, can be a little bit jarring if you go at the wrong time, because that's the same thing that I faced at
Starbucks.
Vegas. Like there were times, yeah, where there were times where it was just really easy to get through, and then there were times it was like, hey man, it's been like 5 minutes, what's going on? 10 minutes has been going on, you know. So I think but the fact that they had a line is a good sign from an investor standpoint.
From an investor standpoint, for sure.
Yeah. What time did you go?
The first day it was like 10 a.m. The second day it was like noon-ish. And like the fact that you're there at like 10 a.m. and noon and there's a line both times, pretty good.
Yeah, that's a good sign. I remember that same logic that I was thinking about when it came to investing in Chipotle, which I didn't, but now I think about it stupid. And I remember my dad loves Chipotle, so he's the way he says it in our language is really funny. But he's like, man, every time I go, there's always a line at the damn store. And I was like, yeah, you know what? Every time I go, I see a line at the store too. Like you go, early in the morning, late at night, always a line at Chipotle, you know. So it just means that there is a captive audience for the product. It's one thing if you go and, you know, there's like one or two customers waiting and that's it. But if you're saying multiple days, multiple times of the day, you know, that's a good sign. And I think this is one of those things that's a newer concept, because they're taking coffee, which is great. People want coffee, but then they have these energy drinks that are custom made energy drinks that are becoming a lot. How do I say it? Like, I think from a society standpoint, we are drinking a lot more energy drinks, right? So if these guys have figured out how to make a custom energy drink that people really like, could be something there, man. You know, because no one else is doing it to the scale that these guys are doing it. From what I can tell, I have seen some energy drinks here and there, like even Starbucks has actually put out there, but nowhere near the traction that these guys have right now.
It was tasty, dude. It was, and I could see myself if it's on my way home. Generally speaking, if I stop by a gas station and need to get gas or just need to like go get a small thing or another. It's like I go inside and I get like a monster. But if a Dutch Bros is on the way home, I could definitely see myself stopping by, which is eating away from that convenience store market share, right? It's not even say Starbucks or anything like that. It's like a completely new market, kind of like what you're saying. And I think that could definitely have a play into it as well. The thing that I was listening to on the conference call, which was pretty interesting to kind of hear about, is they kind of were estimating very much so off of kind of like a $2 million annual run rate per store at the IPO. And what they've kind of seen is as they like the initial new markets, like if you put one in a new city, you're going to get that 2 to 2.5 million per store, right? But I think what ended up happening is in Houston and San Antonio and all that, it's like they don't put them uniformly around the city. It's like they'll look at like a north and they'll put 3 stores kind of like in a few mile radius of each other. And then like almost like what Starbucks does, right? It's like Starbucks, you could literally see one across the street from each other. And I've seen it before. It's not as bad as that. But what you do see is you see a little bit of that sort of clustering in certain parts of the city. And I'm not sure if that's to just like to kind of like put a foothold in or what. But what they do say is they're kind of waiting at the moment, and they're kind of, it seems like what they're calling infill, which is a really important term to me because I do that at work in oil and gas. You do infill drilling, but they're doing like infill holes. So like it's not like they're expanding as rapidly as they once were. They're going to be more strategic about the new markets. And then second, because of at least what they're looking at with build to fit custom sort of buildings, the costs have gone up 30 to 40% based off what their initial thoughts were. And so it obviously brings down the initial returns of that. But it's not to say that they're not hurting by any means. It's just like, the returns on like you said, like I think they're making like 36, they're estimating like 36% annualized returns on like lease opportunities. And then if you do a build to suit, like your own custom, they were like talking about 75%. They're saying it brings it down, obviously, because you're investing 30 to 40% more capital, but it's not like they're hemorrhaging cash. But anyway, I thought it was the conference call is very transparent. They're talking about how they're going to explore different ways of utilizing the real estate to not tie up as much capital, have more, now that they're, I guess, a little bit more known of a brand, maybe more flexible lease structures to be able to open up more stores. And they're talking about, which I thought was pretty prudent of them, they say they generally speaking go on a 12 to 18 month sort of window of when they're opening stores and when. And they're not really focusing on 2024 at the moment. They're already moving on to 2025, which is pretty cool because you kind of can see where things are kind of heading in that sort of trajectory. So just some thoughts there.
No, it's good, man. I like I said, I have it in my portfolio right now. Not a big position, but this is something that's definitely worth dollar cost averaging into, over time. And this is just, and someone's like, oh, they're worried about the younger generation. Trust me, the younger generation is the one that's clamoring for it. You go to TikTok, you go to any social media, you'll see lines of people just, talking about Dutch Bros. And it's the younger audience that are the trendsetters that are usually going to this, so I wouldn't worry so much about that. I think there's also some level of exhaustion from Starbucks being the dominant player, that now that there's some newer entrants into the market, that they're able to, at least to a certain degree, take a little bit of that market share from, I don't want to say, because I mean, the TAM for Starbucks is always growing. They can expand out their TAM like there's no tomorrow. And someone brought it up in there as well, that like, what if they did bottled drinks at the stores? And I'm like, bro, that's eventually a future that could happen, right?
Yeah.
When you look at franchising model, what it is first you make the stores, you brand the stores, you do everything around it, and you do these orders, and then once you get to the point where you're so scaled up, you can put all your core product into a bottle and sell it at the store and make a shit ton of money there too. So I think to a degree right now, their goal is expansion, which they're going to do. And It's going to be very interesting.
That is, believe it or not, the first I had heard about Starbucks was those little Frappuccino things that they used to sell at the store, right?
Mm-hmm.
And that was kind of the first that I had ever kind of gotten. I'm like, what is this? I'm like, this Frappuccino thing is really good. And
Yeah.
then somebody's like, oh, like let's go to Starbucks. I was like, wait, there's an actual like physical store. I just know about these little things. I mean, I was like, I don't know, 11 or 12 when Starbucks started to get really big.
Yeah.
But I mean, there's a lot of things that I could dive into with respect to this, like the
Yeah.
investor presentation. But the thing that I thought was really cool to kind of look at. So these are all the stores that have kind of opened up through 2020 and 2023 to date. And this is the first 4 quarters of how much gross margin they're kind of getting. And that's basically after their goods sold and you know, all that stuff. So basically just like revenue minus cost of goods sold, right? And what they're actually kind of pulling out with what they kind of invest. So obviously the first quarter, they're ramping everything up. You're not going to make any money, but it's like you're already getting 18 to 26% from 2Q to 4Q respectively immediately after. And they're kind of kept talking about this high 20s, low 30s sort of margin once you kind of get up and running in a lot of these stores. So very quick turnaround times with respect to actually getting things. So it's like, yes, it might cost $1 to $2 million to kind of get one of these stores up and running. But after that, you're kind of getting on an annualized run rate basis, 25 to 30% of that money back.
And that compounds.
Yeah.
And that compounds itself. That's the other thing, you know.
And so I think it's hit a point now, and this is another thing that I kind of want to bring up, is with respect to their revenue generation and kind of their adjusted EBITDA. So 250 million, right, is where they kind of are at now from like a quarterly basis, and it might dip slowly. Apparently Q2, as they kind of said, is their busiest month because I'm assuming that's when people drive the most, and so they'll see a 5% decline in the third and fourth quarter, which I thought was pretty interesting for them to say. But this is also with respect to increasing store count as well. So I wouldn't be surprised to see flat or slightly increasing in 3Q and 4Q, but they're aiming for about 950 million in fiscal year 2023 as a whole. The thing that I wanted to pull up is this 49 million in EBITDA, right? So this is adjusted EBITDA, so this doesn't take into account share-based compensation. This 49 is important, and the reason being is because they're spending about 200 to 250 million dollars a year in opening stores at the moment. So they're trying to open up 151 stores, 137 of which are going to be company operated. So if they're spending 200 to 250 million in opening these stores, if you're able to achieve that and basically not have to dip into, say, debt or credit facilities or anything like that, then you're obviously going to be kind of free cash flow positive, right? So this EBITDA, of course, right now is hitting the cash register, but this EBITDA, you have to think, immediately goes out to pay for CapEx to open up these stores. So if you're taking a 49 million, you kind of just annualize that, multiply it by 4. And I know this is very high level like stuff. I'm not going to like, oh, well, it might go down 5% next quarter because of, I'm just saying the company's growing pretty rapidly. You take this 49 million, you annualize it, you get to about $200 million in EBITDA a year, right? Which is pretty good. So,
especially at the growth rate that they're growing, because you can see those improvements. Yeah,
exactly. So if you say, okay, well, they're going to spend approximately 200 to 250 million dollars a year opening up these stores, they're not too far from cash flow break even, right? So it's the point where they're actually going to start distributing free cash flow, which to them, they don't have too much debt on the books. I think that they were talking about they have $650 million in total revolver, and of which I think they're using 200 to 300 million. So they have a little bit more to go. To me, it's not too far off where within 2 to 3 quarters from now, they're going to not necessarily have to tap into that revolver too much longer in order to continue to sustain growth. And the important thing that I think they have in this particular presentation is kind of that outlook for fiscal year 23. Now, keep in mind, you're growing into this year. So now you're going to have another 130, 150 stores that are contributing about $2 million a store. So another $250 to $300 million worth of revenue kind of coming in next year. you're already at, for this year, approximately 130 to 140 million in EBITDA, and your capex is 225 to 250. But keep in mind Q2, which is going to be better than the next 2 quarters probably, but as you go forward, like you said, with the growth rate, you're not too far off from being able to pay off all
Completely
this
fund
capex.
your capex.
Exactly. So it's a point now where I think what you saw in the company, which is, hey, first profitability of say the gross profit and the net profit they were able to get, 5 cents on a GAAP basis, 13 cents on a adjusted basis, to now kind of thinking about the long term, which is, hey, these guys are actually making free cash. That's going to be the next catalyst that I think people are looking for, where they're not actually tapping into the coffers and going out and getting revolving credit loans to be able to continue to fund growth.
Yep. And also, they could probably end up utilizing that cash for either share buybacks or dividends, right? And if you think about it, companies that can grow their dividends because they're growing beyond their capex to expand out, bro, that compounds like crazy. Imagine right now, like you look at some of these companies that you could have invested in a long time ago. If you just look at it, I'm sure that the dividend, if they do issue one, is going to be something very low, like 1 or 2%. But that's based on the price today. If you're thinking about from a compound standpoint, if this keeps growing, which looks like it's going to, that franchise fee is going to be coming in, the new stores ROI is going to be coming in, pricing increases over time will eventually bleed their way into profit margins, which means, once again, you as a shareholder will now have more opportunity to grow along with it. So I'd say this is one of those, in my opinion, if you're willing to put on like a 10-year time horizon, it's not no brainer. In terms of a compounded annual rate of return, and especially depending on which direction they go, whether they want to do capital asset returns via share price or through dividends, either one works really well. So imagine you were able to buy Starbucks in 1996, because I think this is probably not the same, because that was like a long time ago, but think of it as like you got to buy Starbucks in the year 2000. Look at all the growth that Starbucks has had since. So I think Dutch Bros, with its unique business model, with its profitability, could probably end up doing a similar, somewhat of a similar growth trajectory. And just for, there's one thing that I actually saw today on Twitter, if you want to take a quick look.
Yeah.
My wife is out here. My wife is looking at me because she just got home. She's like, get away, get away. Yes. I know. Wait, all right, I'll talk to you later about it. Jeremy from Financial Education, he just posted this earlier today as well. So he's doing some DD on it. So I'm looking forward to what is that thing called? How he responds to this. Right. Because I think a lot of retail investors actually follow Jeremy. So if this is something that ends up getting some more mainstream traction, you could see a huge valuation bump with people going in,
So to give people some thought here, right? I mean, a lot of what I was looking at when I initially did kind of my due diligence, and to give people an idea, like, I don't think I have a very big position. I think it's about $4,500 to $5,000. I also wrote some cash secured puts to be able to acquire at $30. And so I think with those cash secured puts, it's about $1.50 I got per contract. So that would allow me to kind of get in at a $28.50 cost basis if I say get assigned. And to which I would probably be okay with that current position of around, what is that, 350-ish shares for now. And I sold a little bit of Pepsi and I sold a little bit of Johnson & Johnson again in it. I have reinvested all my dividends into J&J and Pepsi. So I only took the shares that I got from those from J&J and Pepsi to be able to buy. And I think I didn't sell all the shares that I got reinvested. I think it was just a portion, but I kept my shares of J&J and Pepsi at about 200 each. So that's still have a shit ton of shares of J&J and Pepsi, considering they're about $160, $170 a share. But regardless, my thought process with this one is I was comparing mostly to Starbucks, and I know it's like not a like for like, but the price to sales for Starbucks is about a 3.5. If you're kind of looking at from that perspective, I think that they sell about $28 or $30 billion worth of coffee a year or something like that. And their price for Starbucks is about 100. When I looked at it, was about 117 billion in terms of market cap, and I think it's down to 110 now with a recent retracement. Dutch Bros, they're going to end the year at about a price of sales of 5. So if you think about it, if they're growing at a 30% rate, within a few years, it's going to grow into the similar valuation of a Starbucks if you let it have enough time. Starbucks is also growing pretty rapidly as well. I think Starbucks had like close to 30 or 40,000 stores, and Bros at the moment only has 600, 700 stores. So in terms of that, you're kind of waiting for that valuation. The thing that did strike me though is the net margin. If you look at store by store and the general administrative costs associated with Bros is way lower than what you have at Starbucks. And that just might be economies of scale, right? Of having such a large organization of Starbucks, you start to lose percentages of margin because you just have inefficiencies with such a large business. But net margins were below 20 for Starbucks. And I think at scale, if Bros continues on this trajectory, they're going to be looking at the high 20s to low 30s. And so with that, I mean, the revenue, if you start thinking about it, if you get to the $5 billion revenue range, which is probably going to be in a long time from now, probably 10 years down the road, they're going to be making $1.5 to $2 billion worth of actual net income. Now, if you start putting a 15 price multiple on that, or a 20 price multiple, where to keep in mind, Starbucks trades at, I think, a 30 times price to earnings multiple. But let's just keep it muted for now. You say $1.5 billion in net income for Bros in 10 years or so. If they do get that 4,000 store sort of goal, you're going to be looking at a $22 billion, $25 billion company at 15 times multiple. If you multiply it by 20, you're looking more at a $30 billion sort of company. So considering the company trades at a $5 billion market cap now, it could be ranged anywhere between 20 to 30 billion if they meet their trajectories, right? It's not guaranteed that they will, but if they do, you could start seeing things compound pretty damn quick. And in 10 years, you're looking at something that's not too far-fetched in terms of where they're at. Now, if you keep sticking on that price of sales multiple, then things don't look as fun, because I think you're gonna say you're only going to be making probably like $5 to $10 billion in sort of revenue. And so in that respect, anyway, so there's a bunch of different ways you can kind of stack it, but I was pretty impressed by the opportunity. And like you said, it's not exactly dirt cheap. If it was at $2.5 billion, I'd be a lot more intrigued. But at a $5 billion market cap, I still think that there's an opportunity to get a 5x pretty easy in this if you're willing to wait, 10, 15 years. So.
Yeah, I mean, it's better than a lot of names that people buy hoping for profitability or growth and stuff like that, versus you actually seeing it day to day. Like, the one thing that I think sucks about sometimes investing in companies, like, you can't experience the product. I mean, you can, of course, with Palantir and stuff, but it's such a closed loop. So if you're not working in a specific industry, it's like you won't get to experience it. Whereas right now, as long as you live near one, you can go and experience it yourself. Go try it out, see what you think. And I think that's the key with investing like Peter Lynch and stuff, where you can actually hold the product in your hand, try it out, and then go from there. So
well, I see a lot of people in the chat be like, oh, it's not here yet, South Carolina. I saw somebody from Massachusetts earlier be like, there's not one here. It's like there's very few east of Tennessee, and even still there's none in Arkansas. There's a lot in Nashville.
There's only 300 total in the entire country right now. Just think about that. In the entire country. Was it 300 or 600? I forgot how many.
600, but
600
enough, right? The magnitude's there, right? So,
right.
But I think like you think about it, it's like they're in Oregon, right? So they're not too far from Vancouver, and you have the opportunity. Like, once you get to New York, you're not too far from Toronto. Like, there's opportunities very quickly to start getting international exposure, once you start getting into it's like, yes, you have competition with Timmy Hose and all that stuff, but it's not too distal to think that you could be in Vancouver, Toronto, all these other markets. There's none in Georgia. I drove through Georgia on my way back from Tennessee. There was zero. There's none in Detroit. There's none in Ohio. There's none in Michigan.
New York City, zero.
None in New York City, none in Philadelphia. So anything east of where I was in Tennessee, nothing. And I think that they said it perfectly on the conference call that they're waiting for Texas Roastery to open up in 2024 to really start hitting it hard, because right now they'd have to drive every single one of the beans from Oregon. And that's tough, right?
Yeah, supply chains are always that issue, man. If you don't have a strong supply chain network, it saps away those margins really quickly, because that means that you're literally having to, once again, spend a whole lot of money on figuring out the logistics. And that's why you need a CEO like the one that they got, who actually can provide that logistical background, and be able to support the entire thing. The other thing is, as you scale up and it gets bigger and bigger, it means that now the cost per bean gets cheaper, right? So now the Houston stores are probably, dealing with some margin issues that later on will actually improve once the roastery opens up in Texas, right? So I would say eventually there will eventually come a point where there is a national chain of not just the infrastructure for the stores themselves, but also the supply chains that are supporting it, that are being done in-house to maintain that quality. And I think that's the key that I like about these guys, that they understand maintaining quality, whether it's through their personnel or whether it's through their input. Because they could just say, you know what, it's okay, just grab any coffee bean from anywhere and just stick it in a bottle and there you go. But then that unique flavor and that experience does not translate from place to place. And if it doesn't translate from place to place, it could end up really like turning a lot of customers off. So if anyone here is interested, they should watch a movie called The Founder, because that is a very good. Yeah, it's a very good movie on how franchise. Yeah. Yep.
Really
how if you have the right person in the right role and the right business model, this can end up becoming something that's a multi-billion-dollar organization, versus if it's in the wrong hands and you don't have the right model, no matter how good the system that you develop, it won't get any further than the few stores here and there. So if anyone here doesn't know, what I'm talking about is like the story of the McDonald's brothers and how Ray Kroc, who was a door-to-door salesman, kind of like partnered with them to franchise out the first McDonald's stores. And like over time, they were able to basically change how they operate. Like, so one of the issues that the McDonald's brother had, was the quality per store was diminishing over time. And so there was very little ways that they could fix it. And so Ray Kroc, with the help of their first COO, actually figured out the best way to do it is to actually own the land under the stores and then use that as leverage to make sure that the store owners are doing what they're supposed to do, and not just fucking up the business, So yeah, Chris is all best case. What you present for end phase bros, interest rate, competition from China, margin compression. Yeah.
Chris to zero, man.
I don't know what he's trying to say, to be honest, but okay.
It is an interesting, and like that was one of the things when they were first starting to talk about it. Like Christina brought it up, like how we're going to experiment with different real estate, and I'm like, do they own? I don't know if they own the real estate per se. Like if they're building to fit, if that means that they're literally buying it, the land, building it, and then holding the real estate or not. Because granted, what might end up happening is like very much what you say, which is the McDonald's model, which is all the McDonald's sit on McDonald's owned real estate. So even if you are a franchisee, they build the store for you, they lease it out, and they basically say you owe us rent regardless of whether or not. So not only do you owe rent, but you're also giving a franchise fee on top of it. And so a lot of times,
and royalties on a net sales.
Oh,
gross
the
sales, gross
royalties of
sales.
that. And so
Yeah.
what people have always talked about is, when the hell is McDonald's going to open up their REIT? Because of how much value that could add, right? If you look at the distributable cash flow of separating the real estate business from McDonald's versus the franchise business, you have two big separate models. They're symbiotic because they both play into a very lucrative business model. I mean, McDonald's is a $200 billion company right now, but
Yeah.
I mean, you have that opportunity to potentially spin it off and do really good. And I don't understand if that's the same for what Dutch Bros is doing, because they were talking easily about $1.5 million to open up some of these stores. It's like, well, if you're spending them $1.5 million, is somebody buying it from you, or are you keeping it? Right? I don't understand
Yeah.
wholly what
My
that
my
means long
guess,
term.
we'd have to. That's something that we have to do as DD, is to
Yeah,
figure out, like, because remember, when it comes to real estate, it's a vulnerability not to own the real estate underneath the ground that business sits on. The reason why is because, let's say you develop a business, right? Like, you own a store, it's a great store, you have reoccurring revenue, you have reoccurring customers, and your lease term expires in 5 years or 10 years. Then the other guy now can hold you over a fucking barrel and get
yeah,
a huge rate increase in rent, because now he knows that for you to move your entire operation somewhere else, it's going to cost you a shit ton.
hmm
So I think that probably this is one of those times where they're probably having to fork over money to buy the land underneath the stores. But let's do some research on that. Let's find out,
yeah.
because
One of the things that they
yeah,
did talk about was that being a headwind, right? 30-40%. I said that earlier. 30-40% more
yeah,
construction build out costs. And the things that they're going to look at are end caps, being the end of. So, like, there's a lot of Starbucks that do end caps now, where they are in a
yeah,
strip mall and they're the last one, so they can still have the drive through, right? So
yeah,
there's a lot of people that are aiming towards that, because it might not be as capital intensive, meaning you can open up more stores faster. But in the long run, like you said, is it going to be the most opportunistic avenue for you
yeah,
to go? And I wanted to highlight this comment particular, because people might be getting confused, and I want to make sure they're not. Corporate owned stores means that they are taking 100% of the gross profit, versus if they're
mm,
franchising out, they're in charge of the brand. That person is paying an upfront franchise fee to be able to use the brand. They'll pay up to $1,500 a week or something like that, or 6% or something like that, whatever is greater, to back to the Bros brand. And that doesn't necessarily mean that the kind of like what Chris are talking about, doesn't necessarily mean that they own the land, right? And so that it could mean that it could be the McDonald's model, but Chris and I have to explore that. That's what we're talking about.
yeah.
Did that make sense, or did I
Yep.
misspeak there?
No, no, no. That totally makes sense, and that's something that, like I said, over time we'll do some more due diligence on it and find out. But I think overall, this company is in a very unique place in terms of growth. I think they're still very early in their life cycle, and for someone willing to, sit on some capital for 10 years plus, there could be a very substantial return on the other end of this. So this is definitely one of those things that you just put away, don't think about it for the next 5, 10, 15 years, and it'll compound itself. And as of right now, it's not being given, in my opinion, enough credit for the trajectory that they have outlined, that I think that they're going to be able to execute,
Yeah. So what are the big headwinds that you think? I mean, other than the things that we're kind of talking about, capital costs to be able to open up stores. I mean, do you see at the moment more tailwind? Do you think it's just more of a wait and see, wait for further catalysts to kind of show up before it's an opportunity for you to go in bigger? Or is it one of those things where it's like, it's a small position, maybe you just lock it away for 5 years, come back, revisit? What would cause you to add more shares? What would cause you to step away from the business? Thoughts around that?
right? I would say, with these franchises, it comes down to product quality and management, right? Because management is what really sets the tone for future growth. So as an example, you look at Domino's Pizza. Domino's Pizza at one time dominated the at-home delivery food pizza business, right? So everyone was getting Domino's. The problem is they let their quality slip, And because of that, the consumers ended up recognizing that, and then they stopped ordering so much Domino's. And it wasn't until their, leadership had to be changed, and they really changed up the way that they did things. Like I don't remember if you remember, like the thing where they showed like Domino's like tasting like cardboard, like the focus groups that they did. And so they fixed it. And once they fixed it, man, they really just killed it in terms of.
Yeah.
So I think what it is when you get terrible management that comes in and says, you know what, maybe we don't need so many roasteries. Let's just go and grab, any coffee beans from anywhere. We don't need to make sure that they're, higher quality stuff. Let's make sure our profit margins are fatter in the short term. And let's sacrifice hiring good people and just hire whoever, because we just want to be profit. Like if you're completely driven by profit, like you will lose that uniqueness to your business. And so a lot of times these franchises, they have a way of losing their soul that made them successful in the chase for ever more profits from shareholders. And I've seen that happen to so many good franchises. It kind of sucks because it eventually, like, the growth will taper off significantly because of that. The other problem is, of course, I don't think this is something to be concerned about. Like humans, we just love sugar. Like it's like a fucking natural thing. But if there's any sort of legislation or anything that turns around, and I know that this sounds like completely impossible, but trust me, it's out there.
It's not.
Where if you have limitations on, sugary beverages being put in place, depending on the locality, depending on like nationally, it could end up hampering their core product. So those are the only two major risks that I honestly see, which is one is bad execution from management in they're focusing on short-term profitability rather than long-term growth, so that's one. And the other one is, of course, a general market trend towards, legislative trend towards, I would say, modifying core products to make sure that this is not something that people want to, be in, so it's like Shaq can't save Papa John's. That's the other thing too. Like, like Jared from the Subway weight loss guy turned out to be a pedophile. So I hope the people that they take on to take brand leadership roles at Starbucks, not Starbucks, at Dutch Bros, don't partner with someone who eventually comes out and ends up causing like a fucking PR nightmare. So
no, I think people might laugh, but the soda tax was a real thing in Philadelphia, and I don't know if it still is, but so that's a thing where it could be something where they limit actual like sales overall. I mean, who knows with the way that some of these cities are run these days, they could literally, if they won't let you even like enforce people stealing from your goddamn stores, who's to say what else is they're going to be able to do, right? So I don't want to get too political, but it's just the truth, right? I'm not trying to hide anything. I'm being transparent. So I see that 100%, and I've seen that as well with companies around this size or slightly smaller, where they go public or somebody buys them out, takes them private, or somebody takes them public even. So multiple revenue, but it's basically, like you said, centered around money. They take a good product, they merge it with another brand or something like that, and they're like, oh, well, I have Mary's Mediterranean cuisine, and here's this company, let's merge it together. And next thing you know, it's like, well, you used to have the best of one, and now you have two that are kind of where one had an edge, one of them didn't. Like Verts Kebab. I don't know if you ever had Verts Kebab, but Verts Kebab was huge in Austin. It expanded to Texas. It was one of my favorite chains. And then the guys that sold it, it was starting to get pretty big. They sold out. They took their $100 million or whatever somebody was willing to pay them. And they were in their early 20s. And they basically just said, here you go, private equity fund, go have it. And it changed the Verts Grill. It changed to Mary's, like God knows what. And then it just went belly up. They're nowhere to be found now. None of them, any of the old remnants, like the whole thing turned into a complete garbage fest. And it got liquidated for parts. And so I've seen that happen to multiple different companies. One that was very famous in the Northeast, me and my buddy were just talking about it. It was very similar to Kava, which I just had for dinner for the first time. I thought that was there's pluses and minuses. I'm not as impressed. The sandwich thing was good, but the actual like grain bowl was kind of it could be better, but it was still a decent meal, right? So nothing to write home about, but a decent meal. And I could see how there was a company that was like that probably 10 years ago that was really hot. Somebody bought it. It expanded very rapidly in the Philadelphia area. And then within months, just started closing down one by one. And it was because somebody was trying to get too aggressive. And so it goes back to what I was saying earlier in the stream, which is making sure the EBITDA is close enough to cover all the capex of the business.
Yeah.
That is, to me, the next most important and thing that I'm going to be looking for, where they are cash flow break even before I probably make another tranche of investment. And I want to highlight to people in the chat, Chris was talking about it earlier, and I want to highlight that and hand it back to Chris for any final thoughts. I looked very strategically at what I had in my portfolio, and I said, I don't think J&J or Pepsi is going to 5X here in the next 10 to 15 years. And I said, I think that this is a potential 10 to 15 year play and letting it see it fill out. I'm willing to take a portion of my J&J, a portion of my Pepsi, where it probably will be a steady holder of value, but it won't be a massive grower of value, if that makes sense. So it'll probably it might have probably underperform the S&P 500 in the next 5 to 10 years. But I'm taking a portion of that and saying, let me take a speculative bet that could have exponential returns comparatively to the opportunity cost of just investing in the S&P 500. But I'll dabble in slowly, like you and I were talking about, right? Take it in a slower sort of matter. I could see within a year or two this becoming a $50,000 position if everything kind of goes in the right way for me, which a $50,000 position is probably fully funded. It's the size of my Amazon, the size of my Google, a little bit smaller than the size of my Palantir. But if things continue to hit the right trajectory and it gets cheap enough, I could see myself doing that. But I'd say it probably will stay at a 15 to 20,000 if if it continues at about what I'm expecting. So we'll see. And I'm not like too hyped up because, like you said, it's still a little expensive, and it might be like in 10 years down the road. It's like, man, I only got that $5,000 position in, and now I only have 25 grand or 30 grand or whatever it grows into. But I don't know. But it's one of those things, Chris, and maybe slap me in the face if I'm wrong. I'm like, do I just take 50 grand, put it in, wait to see what happens in 10 years, and it could be 250 grand?
Oh man, I think this is one of those things that you just set up a monthly dollar cost. No, just set up a monthly dollar cost average, and just $100 every month, and just be like, you know what? Every time I'm hankering for some energy drinks or something, I buy my coffee and then take that $5 I was going to spend on my coffee and put it towards Dutch Bros as well. So this way it doesn't feel like a large investment that you're going to be tracking. I'm telling you, like, imagine right now you had just done dollar cost averaging into Starbucks since the year 2000, where every week or every month you just took a couple of, $100. You don't have to take a lot, just a little bit of money, put it in, and boom, you would have been in a much, much higher position, So I think this is one to dollar cost average. There is one IPO that I'm looking forward to. I love the restaurants. I have to find one around Atlanta.
Oh, it's a restaurant. Oh, is it the one you were telling me about?
Wingstop? No. That's another one I'll tell you about. It's called Torchy's Tacos. You know Torchy's.
Oh my God. Texas. Yeah, they're IPOing.
There was rumor they were supposed to IPO like in 2021, but then they kind of put that into kibosh. Bro, I can't wait for that to come out. Torchy's is fire, baby. Fire.
It's crazy, man. If you want Tex-Mex tacos, that's definitely the spot. I had no idea. I thought you were talking about Hardee's because you and I were chatting about Hardee's last week as well.
No, that's something else we'll talk about. Not Hardee's, but the AI technology around Hardee's.
Oh, that's what it was.
I know. Yeah. So Torchy's, man. Is there Torchy's around here? Fuck, I think there is. Man, I gotta tell the wife.
I thought Torchy's. So I thought Torchy's was like a fucking elephant in, like, I don't know what the word I'm looking for. I thought it was like a crown jewel. I thought it was like a 1 in a million sort of store. Like they didn't franchise. And then I realized maybe it's rather new, but they opened one in Houston when I moved here 10 years ago. And I was like, what the fuck is this magical place? and we would go to a microbrewery or whatever on Saturdays, and afterwards they would close. We would go get Torchies, and it would always blow my effing mind. And then
there's
they started
there's
opening
none
them
in
up all over the place.
Yeah, there's none around me right now in Atlanta, but dude, Torchy's is like it's if you're in Texas, I always get Torchy's.
It's good.
Last time I was there, it was really good. So if they IPO, bro, I'm getting some Torchy's. They're like the next Taco Bell. Oh man,
I don't know about Taco Bell, but yeah, it's Velvet Taco is different. I prefer Velvet Taco is not bad, but I prefer Torchies personally.
Yeah. All right, man. Well, this was a good conversation. I have to get out of here, talk to the wife, and get ready for work.
All right, man. Cool.
All right.
Thank you.
Later, man. Always a pleasure.
Yep.
Take care, guys.